Happy New Year, everyone. We hope you had a healthy holiday season. This is the first webinar for 2024 from Principal Wealth Partners. It is titled Closer to Normal. I'm Julina Ogilvie, partner and wealth advisor here at the firm, joined by Bob Paolucci, our founder and CEO. Bob, this is a whole new year.
Yeah, Happy New Year.
Happy New Year.
New Year.
Sorry, go ahead.
No, I'm happy to be in the new year because I think it's going to be a great year, like last year was.
Yes.
So it should be a very happy new year.
Yeah, I was took the words right out of my mouth. However, we do think it'll be a slightly different year than what we saw last year. So let's get into this. I want to quickly review a few keynotes from 2023. We want to talk about how Wall Street got it wrong. We want to look back at our outlook from Principal Wealth Partners for the year. We want to discuss rolling recessions and recoveries and where we believe we are with that. Inconsistent data and how that defined last year and the volatility that it created. And then we're going to talk about how the Fed was right, but back in 2021 with their transitory definition of inflation. We are then going to look ahead into this year, and we want to address what we believe matters the most. We're going to talk about the direction of interest rates, earnings. We're going to talk about dry powder on the sidelines, meaning the hordes of cash that we see. And then we're going to quickly go through the equity and fixed income themes. And believe it or not, we are in another election year, so we do need to start addressing that and how the markets react. I'll kick off the review of last year. The first title of our slide is the beginning of a new bull market. There is a lot of information on here, but I think it's very important. We're looking at broad asset classes across stocks, bonds, international, small companies, large companies. And what you're going to see is going all the way back to 2011 on the left-hand side to last year on the right. We have had periods of broad sell-offs, which are shown in red, followed by periods of broad recovery. And that is exactly what we saw last year, coming off of the 2022 decline, all the way on the far right. But we also saw it in 2018, and we saw it in 2015. So this is very common. But just to quickly highlight, in 2022, cash was king. There were only two asset classes that were positive. Cash was up a whopping 1.4%. And then, believe it or not, commodities had a very good year. But in fairness to commodities, they were probably the worst place to be after 20 years with the most amount of volatility. So they were probably justified their due. But not surprising, they had a terrible year last year in 2023 as everything else recovered in a very broad recovery. We're going to talk about it. Most of it was driven by large companies and growthy names. But that really is the stage that we're setting going forward, if that's fair, Bob.
That's fair. Yeah, and you can see there's consistency if you look at this chart. Bad years are usually shared by many asset classes, and good years are usually shared by many asset classes. Part of that has to do with low interest rates making everything highly correlated over the past decade. We think going forward there will be less correlation, which is a very good thing, better for diversified portfolios going forward.
Yeah, for sure. And I think that this is setting a really good stage for the next slide, which I know you're a big fan of, Bob, because candidly, Wall Street did not call the returns that we saw last year.
I absolutely love this slide because the amount of time that investors, our clients, people, us to a degree, spend listening to quote unquote professionals talk about their forecast for the future with very little backup data and rationale as to why they think things are going to go the way they're going to go. The professionals were wrong again this past year. The average forecast was for the market to not rise coming out of 2022. And oh boy, did the market rise. And again, this is an aggregate grouping of pulling all of the big Wall Street firms together and aggregating their average level for various markets. We're showing you the big one, the S&P 500. They were on the other end of the spectrum when it comes to what actually happened and what they forecasted. It couldn't have been more different. So spend less time listening to hedge fund managers and billionaires and professional market forecasters. A lot of that is just hot air marketing, and things can change very quickly.
Yeah, one of the things we pride ourselves on as an independent firm is we have our own research, we have our own beliefs about the market, and we don't always agree with Wall Street. And last year was certainly one of those years. So what you're looking at here is a slide that we showed you in January of 2023 for our outlook, which was not in line with Main Street, which was, we talked about weakness to strength. In fact, and this was very deviant, inflation we believed was low and set to go lower. Interest rates, we believed that cuts were eventually coming. We talked about consumer resiliency and confidence. We talked about going from a bear to bull with valuations that were attractive and corporate earnings that were not as bad as expected as Wall Street. And then finally, we talked about higher income was going to be more than people believed and how these yields would be attractive and entry points for the market. And we, as always, we love talking about dividends and buybacks and the strength that it has in the market as well. One last point is we did talk about the recession. We did not believe that we were going to enter a recession. And if I can maybe take that one step further, this is a discussion that is ongoing. We're coming off of 2023 that was the most discussed recession that never occurred. And the reason that it never occurred is because we believe we were in what's called a rolling recession. There were points of recession in different areas of the market. Travel and oil, for example, at the top of the page. Those red dots show those recessions that were earlier on in 2020. And then you had other areas of the market like housing and semiconductors at the bottom of the page. And they didn't enter these recessions until late 2022. So because it was so rolling, there was never a definition of a recession. And I think the really good news is we're seeing this recovery ever so slowly moving forward, if that's fair, Bob.
That's fair. I mean, ultimately, if you have a rolling recession, which really just means, you take half of the data, right? Whether it be housing, travel, the price of oil, inflation, semiconductors, employment, all the other stuff. We didn't have everything flashing red in alignment at the same time. What we did have was a lot of green, a little bit of orange, a little bit of yellow, and some red. And then you fast forward a couple of quarters, we had some red, maybe a little bit less green, a little yellow, cautionary stuff. So we didn't have anything lining up. You could move the calendar a little bit and draw on a diagonal line. We've talked about this, and yeah, I guess you can come up with a recession, but that's not how you do it. It has to be in alignment, happening very close together, typically within 2 or 3 quarters. And we just didn't have that. So, our prediction, January of last year was correct.
Yeah, exactly. And
Yeah.
I think another area of inconsistency was jobs.
Perfect chart to show how volatile the data has been. It's very easy um, to view very consistent data and make forecasts off of consistent data. It's very difficult when you have data that is just changing wildly from month to month and quarter to quarter. And what you can see really since 2020, prior to that, you had somewhat consistent data, small ups, small downs. Since 2020, I mean, you had this enormous swing in the information, which really does create volatility in various markets. So, the major contribution to the volatility that was seen, let's go back a little further, in 2022 was due to the fact that the data was all over the place. So, when the data is all over the place, it's harder to predict. When it's harder to predict, Wall Street tends to be super cautious. They tend to oversell. They tend to be very bearish, and they wait to be proven wrong over time.
Right.
And they have been proven wrong.
Yeah.
So the data, the great thing about entering 2024 is the data is becoming much more consistent. We're phasing out some of these measurements that have captured 3 years worth of data, 4 years worth of data, and it's still in the number from the pandemic, of course. Now we're getting to a period where a lot of the economic data, a lot of the corporate earnings data, it's starting to fit back in that normal range. Even though it's still a wide range, it's much tighter than what we're looking at here.
Yeah, fair. And And what's so interesting about all this inconsistency from last year is we thought it would be relevant to point out because we do realize that a lot of our clients don't just look at the statement at year end, but they're looking at it throughout the year. And
Throughout the
all of
year. How
this
about every day?
inconsistency, yeah, every day. But it creates the volatility in the markets within the year. And so when you look at the calendar year of last year, it is interesting to note that the majority of the months, in fact, over 9 of them, had movement in either 2% plus or minus in a direction. And so there was a lot of movement within the year. And it's so interesting that in the fall of the year, you actually had a market drop of 10% within 3 months. And then just as quickly as that happened and people realized that it did, the last 2 months were positive 10%. And so
Yeah.
I think it's always a good reminder that we do have this volatility, but it was unique with the inconsistency last year.
Yeah, in this, I know this looks very volatile, but this is a normal year in the market. You had 8 positive months and 4 negative months. One, let's call it flat month. And remember, the negative months, I think emotionally, they feel a lot worse than they really are. And a lot of the positive months, the average positive months, I think that's just your expectation, so you don't weigh it that positively.
Sure.
Like the November, December months, they really have to pack a punch to make a positive difference. Because I think, when it comes to investing, a lot of people they want, expect, and need positive returns, so they don't. It sort of meets the bar.
Yes.
I think they just don't weigh it properly, and the negatives they overweigh. So, but here's how it works, and this also tells you, don't measure too frequently. You'll drive yourself nuts. There isn't a market that is a variable market that is consistently going to give you positive returns. The positives create negatives, the negatives create positives. If you think about a stock price goes on sale, so it goes down. What does that do? It attracts other buyers, then it gets bought, price goes up. So you have this up and down, up and down, up and down, up and down.
Right.
Measuring over a month or 3 months or 6 months or a year, very hard to do. You really should have a multi-year view and measurement system, or at least an internal emotional controlled measurement system to keep you calm, right? So the
Yeah.
calmer you are, the more you trust us to allocate money appropriately, and the more time you give us, the better results will be seen for everybody. But it just proves to you just can't measure too frequently. Don't measure by the day. Don't measure by the week. Don't measure by the month or quarter. Look out in years. That's how you make a lot of money in the variable markets.
In other words, you can look at your statement every day, but don't change your investment behavior based on that.
Yeah, and the vast majority of investors, most professionals, even never mind, non-professionals, clients. Um, I'm just going to say it, you really don't know what you're looking at. You don't know the impact of dividends on the price of a security. Um, yeah, you don't know the impact of bond interest and how it might pay in a future month because it was posted at the end of the month but hasn't settled yet. So there's a lot of stuff that can cause confusion for you. Don't get emotional about it. It is just the way things are processed.
Fair. Thank you. And I think one last point from last year was, did the Fed finally get it right?
Yeah. All right. So listen, I think you all heard about the Fed saying inflation was going to be transitory back in 2021. Well, they were right. It's just the impatient nature of media, us, investors. When the Fed says something, and they put this vague in the future word describing when it will happen in front of us, we want it to happen now. They were right all along. What this chart really does show is that the vast majority of inflation was tied to the disruption in supply chains. So you have that orange dotted line overlaid with our inflation, CPI inflation. And boy, oh boy, are they highly synced to one another, especially in 2021, 22, 23, and soon to be 24. So that supply chain pressure, for the most part, is done. And you can quickly see how inflation is coming down with it. So yeah, it's kudos to the Fed in 21 for getting it right. Unfortunately, they maybe should have started increasing rates in 21 instead of doing it all in really 2022 and a little bit in 23. But it is what it is. It's behind us now, and we're moving on.
I think that's a really good review of last year, which sets us for the stage for 2024?
So yeah, so ultimately there are hundreds of things that move the markets daily, weekly, even monthly. However, there are three main things that you really need to measure and observe to help you come up with an accurate prognosis for the future of the market here. And these three are usually the top three. And this year, they definitely are the top three. And what matters most in the market, which helps fuel our opinion of what's going to happen, number one is going to be interest rates. Because we are starting the year with a level of interest rate set by the Fed that is in something called restrictive territory. So the Fed has brought rates not to a normal level. They have intentionally brought interest rates to an abnormal level, way above where they think they should be. And so far, in a short period of time, we are somewhat, as an economy, tolerating that restrictive level of interest rates. The Fed mentioned in December that they are set to cut rates this year, some point this year. They don't tell you by how much because they don't know either, but that is in their forecast. And now that is in the market's forecast as well. So getting to a closer to normal interest rate, or the beginning of their path to get us to a closer to normal interest rate, number one. Number two, corporate earnings. The earnings of the companies in the S&P 500 drive, along with interest rates, the direction of the S&P 500. We're going to show you a chart later on that proves this point. If earnings go up, prices go up. If earnings go down, prices go down. Period. End of story. So we're going to take a look at earnings. Very important. And ultimately, what really enables the market to move is money in motion. More importantly, is there money that can be put into motion? Right? So you could have a very good setup with interest rates. You could have positive earnings. But if you don't have investors deploying money into the stock market or into the bond market, well, there's going to be no movement because a market is driven, or price is driven by, in an up market, more buyers and sellers, in a down market, more sellers than buyers. So if you have buyers, let's hope they have lots of cash to invest. And we're going to show you later on what that looks like. It might be very shocking to you to see.
That's great. Yeah.
And I should also say, we're using these three and honing in on these three to make your life better as a client. So you can just sleep on these three items and understand that these are the most powerful items that we have in front of us this year that will drive markets very likely for years to come. It's a very good setup. We can go, probably create a list of 100 items. Yeah, some things matter, but that's very short term. These are the most potent things for every cycle in the market. And we really want to dig in deep to explain to you the setup and why we think it's very positive.
No, that's great. And I think to these 3 points, starting with interest rates first, something that we have shown before is, when you look at the history of interest rates over on the far right, you can see that dark gray line ascending into the most aggressive rate hike we've seen, ending last year just shy of 5.5%. And now we've paused. And the question, of course, is where do we go from here? So visually, there's two things we wanted to share with you. One is, what is the market expecting, and what is the Fed expecting? Both of them are expecting to cut over the next couple of years. The dark blue line is the Fed telling us they believe they will cut about 3 times. The market is the green dotted line. They believe that they will actually cut more than that, possibly 5 to 6 times. Either way, we are in a position that we believe there's an opportunity in the markets that are positive for bonds going forward. And Bob, I know you have a comment there as well.
Yeah, we're in the camp that the Fed is probably going to cut a little more than what they're saying right now, because what they're saying right now is backward looking, right? Their future forecast for interest rates was using all of the backward looking data. In December, they pivoted. And what they said was, we understand the lagging effects of our data and potentially how it influenced our estimates. And we also understand that when that data is no longer lagging and showing up live in English, once we start to see the next couple of months of data, we will be changing our outlook. Our forecast will change along with it. That is code for the Fed pivoted and they went from talking about hiking interest rates to now talking about cutting interest rates. And generally speaking, you're going to hear people on TV talk about the fact that, hey, when the Fed decides to cut interest rates, that's because the economy is slowing. That is nonsense. That is first level thinking. The Fed is moving rates from not normal rates down, they're moving it from a restrictive level down to normal. That is very different. And I don't hear people on TV talk about that enough. When you have a scenario where they're cutting rates from normal levels lower, then it's because there's major economic weakness and stimulus is needed. When you have a Fed that's cutting rates from an emergency level that was way too high in order to help bring inflation down,
Yeah.
The Fed can come down a lot faster because they're just getting down to normal. They're not going below normal. And that is something I can assure you they really don't want to do. Um, over the next couple of years when they finally get rates to normal, they don't want to set the expectation that they're going to go to zero again. They really want to keep rates around 2 to 3%, somewhere in between there. And we're at over 5.25. So I expect them to cut more because they can, and because we're at an extremely high level and we're just getting closer to normal. So you will see a Fed that can and has cut more from those levels. Does that make sense?
It is. And I think a follow-up to that is we can't have this conversation without addressing inflation, right?
Right.
Which we also know continues to drop if you can go through that.
Yeah, wonderful chart that's going to be hard to decipher here. But what happens is the data on the left, when the new inflation data is reported, it rolls off. And what happens is on the right, the new inflation data rolls on. So this chart just kind of shifts to the right and it drops off the categories on the left. And what you see on the left, just visually, if you look at it, you see a lot of yellow on the top left, and down the bottom, you see a lot of red or
Red.
orange. Yeah. So that is the inflation data that is going to roll off as new reports roll on. And what's been rolling on, just look at the entire right-hand side of this chart, it's all green. Not only all green, you actually see a lot of negatives in front of some of these categories. So what's rolling on is significantly cooler inflation data. And we are, I believe, going to see a major drop in inflation in February with the January report coming out in February, because the February inflation number is so high, it's set to roll off, and a new lower number is set to roll on. And then once again in March, reporting the February number, right? Because it's stale by a month.
Right.
Again, we're talking about stale data here. And here it is. Here's an easy
And that's
chart.
a better visual of that. Maybe a little bit cleaner than the last slide, which was showing every category, right?
Absolutely. So what you're going to see here is almost one full percentage point of inflation is set to roll off. I believe no more than 0.5 point, potentially a quarter of a point will roll on. It's very likely that in March, mid-March, after the February release of the inflation data, we will have inflation close to 2.7%. I'm very confident about that. So now, stay with me here. We're giving you the data behind our recommendation for the Fed cutting rates a little more than expected. This is the granular data. I think you should hear it. It'll help you decipher why we're saying what we're saying. It's because the Fed doesn't want to have interest rates at 5.25% when inflation is half of that.
Continuing to move down.
Yeah, short-term
Yeah.
interest rates and inflation should be, right around one another, plus minus a little bit. You can't have a rate for a long period of time that an interest rate that is double inflation.
Yeah.
That is absolutely ridiculous. And that is actually something that Janet Yellen mentioned in the month of December.
Right.
She is trying to influence the Fed, the entity that she used to run in the prior administration. She's trying to say, hey, people at the Fed, interest rates are too high, inflation is much lower. I just want to make sure you wake up and smell
Yeah.
the roses. And she said it in a nice way. But ironically, a week later, Jerome Powell said, you know what, maybe it's time to stop increasing interest rates and maybe it's time to start cutting. So she has some influence, and I hope she keeps opening her mouth and sharing that influence with the Fed because it is needed. The Fed's going to bring rates down. Inflation is coming down. That will be a theme played out throughout the entire year. Just you wait.
For sure. And we appreciate that interpretation.
Mhm.
And one last comment with inflation, if you can address financing costs.
Yeah, it could also address why people feel a little sour financially in the country. It's because the new interest rates that we have that were just thrown into the mix over the past 18 months really have made a difference. What we did here for you is really illustrated a home purchase. You buy a $300,000 home. We're just using easy numbers here. At a rate of 2.75%, just about all banks were offering 2.75%, many of them with no points to get a mortgage. You finance it over 30 years, that totaled about $1,224 a month, right? This was literally just a few years ago,
Yeah.
2020. Towards the end of 2023, you buy the same house for $300,000 at an interest rate of 7.5%. The monthly payment is about 2,100. That's a 71% increase. And we're not even factoring in property taxes and insurance, both of which have gone up. So you could see that there's some consumer weakness a little bit, or maybe a disgruntled consumer who can pay for it. They just really don't like paying significantly higher interest rates for
Yeah.
things. So a 71% increase in the cost of housing, or financing a car, or financing a house, or financing the federal deficit. We illustrate to you a car purchase. You buy a car for $30,000. You will be able to finance it for 0.99% 2 to 3 years ago. Your monthly payment was about $370. Today, the same $30,000 car is financed at 9%. For the same period of time, it's almost $500. So that's greater than a 30% change. But here's the big one that is also subtly going to influence the Fed. If you look at $30 trillion of federal debt in 2021 at an average compounding rate of 1.7%, that was a very low $570 billion of interest costs for the government to pay, right? So that is a major government expense. However, that same 30 trillion, I'm rounding down by 10%, just to keep the math easy, with a new interest rate of 3.4%. Now, I know that sounds low, but it's the average rate because many of those securities, the low yielding securities, haven't matured yet. So the average rate of, let's call it 3.4%, keep in mind this is an interest only payment, gives you about $1 trillion interest expense. So it's amazing how monetary policy or higher interest rates and the need to fund federal finances through our bond market has created at higher rates, has created an insane increase and almost an 80% increase in interest expense. What is that going to do? Well, it's going to cause some issues. And I think the Fed is also aware of that, as well as the Treasury is aware of that. So this is another reason that the Fed has to do something to go from emergency high rates closer to normal sooner because it's getting very expensive, not only for people and businesses, it's getting expensive for the government.
The government. Yeah.
Yeah. Julina, they won't say that,
No, of course
but
not.
I can assure you it is creating a major, major issue in government, as I think everyone listening to this understands.
Yeah. And I think a follow up on that, because as long as we're talking about the government, something that I think a lot of individuals are very aware of, right? And we are coming into an election year is government spending in general.
Yeah.
Can you
Now,
talk
this
about
is
this?
all under the umbrella of why we think the Fed is going to cut interest rates more than they're forecasting. And we're taking the long road here, telling you, look, uh, here is the 2023 federal budget, and the sources of financing are on the right. On the left, you have total estimated government spending. All of those categories are going to go up for 2024. And on the right, there's this big gap, and there has been a big gap filled by borrowing money. And that is when we sell treasury bonds. This government sells treasury bonds to raise money. There's interest on those bonds. All the categories on the left are going to rise, and some of the categories on the right are going to rise. The one that we think is going to rise the most is borrowing. So something's got to give. I think the Fed can make a big difference here by bringing rates down by 1 to 1.5% this year, so the government can finance its shortfall and pay its bills at a lower rate. So I think this is going to have some influence. You may hear some professionals on TV talk about this. You will not hear the Fed talk about this. I shouldn't say you won't. It's unlikely that you will, because they're a neutral entity. But I can assure you, interest expense of $1 trillion per year is a major issue.
Yeah.
So this is playing into the Fed has to cut rates.
Fed has to cut rates. Again, another reason. We're kind of ending on a very depressing tone, maybe. So I think to transition, we can talk about some of the areas of the market that we think are bringing opportunity this year. And one of those, as Bob mentioned in the introduction of this year, is earnings. And we've mentioned this before, but it's always a good reminder that earnings are correlated to market return, which basically you're looking at here, with the price of the market being the light blue line, and the dark line is your forward earnings. And, sometimes the markets tend to look ahead, so they're not perfectly correlated, but over time, as we have said over and over again, earnings drive growth. And then maybe if you can address that with the next slide.
Absolutely. So, the biggest mover of stock prices is going to be earnings. And what you see here is the total return attributed to various categories. Multiple growth, which is, are you willing to pay a premium for stocks or a discount based on their projected earnings and interest rates? Dividends. So, if you buy a company that has a 5% dividend, and the total return for the stock that you bought of the company returns you 5%, well, then 100% of your return came from the dividend. That's illustrated in this chart. What percentage of the return were dividends? And you have earnings growth. And earnings growth seems to be, I'm joking, it is the big driver of return, both up and down, right? And when you look at the cumulative return for the market, it had a 58% return over 4 years. So the full year 2020, the full year 2021, the full year 2022, the full year 2023, with 22 being a negative year, it still returned 58%. 42% of that return came from earnings. So this is why we talk about earnings and say it's very important. And it'll only be more important going forward. The great news is earnings are set to increase this year and next year pretty substantially. And we think, generally speaking, the forecast is always very conservative. The analysts who create these forward projections, they are very conservative. They don't want to go out on a limb. Actual earnings versus projected earnings. Actual earnings are almost always higher than projected earnings. So another reason to be very positive looking forward.
Thank you for that. And we mentioned this earlier, but the cash on the sidelines and we've talked about this, but the massive amounts, and as we titled this slide, the sidelines and the stadiums are filled with cash. This slide is unique. It actually goes back to 1983. We have shown other slides in a shorter time frame, but to look all the way back and look at the amount of cash that has skyrocketed over the last few years towards the right. I remember back in 2008 in the financial crisis when hordes of cash were created, and now it looks like a little blip on the radar. Right?
It barely registers. Yeah, there was such an enormous stockpiling of cash. You can kind of see it if you squint just above the '08 area. It went from a low level to a higher than low level, which if we scaled it back then would look like a huge mountain. Now it looks like a blip on the radar here. compared to today. So again, the themes that we talked about, the direction of interest rates lower, the direction of earnings higher, and the third one that matters quite a bit is there money that can be invested in the markets to move prices up? And if the answer is no, you'll probably just have a sideways market. If the answer is there's more money than we've ever seen on the sidelines, in second place is not even close. This right here, what you're looking at, is going to fuel a multi-year bull market, period, end of story, in bonds and in stocks. So generally speaking, money comes out of cash or money markets or short-term treasuries. Even though they're yielding quite a bit now, they're not going to yield as much very soon.
Exactly.
And money chases better return, right? Money always finds a home in a better yield or better return over time. Yes, it requires a little bit more risk taking, in some cases, a lot more risk taking, but it tends to always happen always over time. Feels like it happens slowly. It actually happens pretty quickly.
Mhm.
There is a mountain of investable cash sitting on the sidelines, and as we say, and in stadiums because there's so much that is going to find its way into the capital markets. It already is, but very likely for the next handful of years. I hope it doesn't happen too soon because then you would have a market that just goes to the moon,
Right.
uh, and then it runs out of energy. What will likely happen is what has happened throughout time. It slowly finds a home in the market and props the market up.
Yeah.
So you're going to have a lot of this money invested. This is making us very optimistic, not only for this year, but potentially for years to come.
And one quick note before I switch slides, this is just consumer cash. This
It's
is not
consumer
corporate
cash.
cash,
Good point. Good
right?
point. If you look at commercial cash or corporate cash, which is also rising because companies are pension funds want to buy higher yielding securities than treasuries.
Hmm.
So they are very hungry for corporate bonds. Corporate bonds issued by publicly traded companies. There are big companies, big US companies, even big non-US companies that are literally creating a bond offering so a pension can buy it and get a slightly higher yield than a treasury. And by slightly, I mean just slightly higher yield. So there is an enormous demand from pension and endowments to buy corporate bonds. I've even heard that many of them over the past couple of years have reached out to, Apple and Amazon and all these gigantic companies to say, "Hey, I just want to let you know, if you do a bond offering, we're going to buy it.
Yeah.
So if you're thinking about it, hurry up because we
Hmm.
want your bonds."
Yeah.
So there is an enormous amount of corporate cash created, right? So you
Yeah.
issue a bond, an endowment buys it, or a pension fund buys it. Now you're the company, you're sitting on a mountain of cash. You
Yes.
need to deploy that. So there is a reason why these companies are more resilient today. All this cash and all this wealth is a good reason why maybe we haven't gone into that recession because there's so much money out there. It's a unique situation that we have, and it really is providing sort of a rail protecting us from economic really bad economic situations because
Buffer.
there's a lot of wealth, there's a lot of cash, there's a lot of money out there, both in the hands of corporations and people.
Yeah.
Shockingly high amount of money.
Yeah. So there's an opportunity from both perspectives. And I think just one more clarification on this from a consumer perspective that you mentioned, in that it sets the tone, not only in the short term, but possibly the longer term. If you're looking at this slide, it shows what happens after the Fed has ended their hike cycle.
Yeah.
And the left-hand side shows cash in the dark blue 1 year following relative to core bonds. Core bonds more than double cash in 1 year following. You look at US stocks more to the right, which almost quadruple the return. And then even a blended portfolio on the far right almost triples that return. So that's over 1 year. But then this slide goes even further to say, well, what happens in the next 5 years? And you can see a very similar tone where bonds, stocks, and even a blended portfolio far outperform cash. So I think there's an opportunity here, not just in the short term, but it sets that stage for the longer term as well. So
Agreed. And we've been saying over the past 6 months or so in these videos that we do that, cash is king for a moment. And usually the year that cash is king, it's because everything else, was either negative or flat. And that was 2022. And usually the year following, cash is the worst investment. And it doesn't mean it's negative because cash doesn't go negative, but relative to everything else, we led off this presentation with the full chart of all asset classes, and cash was on the very bottom of the list. So there are better homes for cash, and there will be for quite some time. So we do like the absolute return of cash right now. So for most of our clients, we might have a little bit more than we normally have. We have some bonds that are starting to mature. All of that is going to be put back into your normal asset allocation. Cash is going to be a yielding security where the yield goes down throughout the year. It is the most sensitive to the change in Fed rates because it is the shortest term investment that you can have. It's cash. So typically within 5 to 7 days, if the Fed cuts rates, your money market yield is going to go down within, roughly within a week or so, whereas there isn't as much impact to, or really negative impact, any to longer dated securities. If anything, those securities rise in value. So it's critical moment here and something we're ready for.
yeah, absolutely. And I think we should stay along the conversation of consumers and spend a little bit of time talking about the consumers going forward if we can.
Yeah, and it's why we have the cash, right? And the reason why we have some of these charts in here is they're tied to the main themes. So consumption drives economic growth. So we just showed you a chart of how much cash there is out there for consumption. And what we're showing you is total consumption of our economy. And you have residential, you have business fixed investment, you have change in private inventories, you have exports, you have government spending, which is also, you know, uh, real spending as well. But consumption, that light blue category, is always a big chunk of our economic movement, whether it be up or down. If it's down, it's lack of spending. If it's up, it's certainly spending. It makes up an enormous piece of our economic growth. And we expect people to continue to consume, whether by habit, by need, by choice. It's just going to happen, and there's money to be spent, and there's certainly stuff to be consumed. We can argue about that at another time. So we think the economy will keep moving forward, and we shouldn't have a recession. What we might have, I should mention this, is less than fantastic economic data. It might not be bad. It's just less than really good.
Mhm.
That's still let's call it a downer, right? When you look at the trend, but at the end of the day, it's still positive growth.
Yeah.
It just might not be as good as it has been. And that's okay. Our economic growth has been above trend. Let's get back to trend, and that's a very good thing. The media will make you think it's a terrible thing.
Mhm.
It's not. Normal growth in this country is low. It's usually around 2%. If we get there, that's completely fine.
Yeah, and the recovery is not going to be a straight line, but it's really important with this slide. We are a consumer-driven economy, and I think also what's nice to see is that consumers still have jobs.
Yeah. So the consumer's still spending. Why? Because they're employed.
Yeah.
So they have a job. You still have the unemployment rate under 4%. I mean, 4% is a rounding error. We have full employment.
Yeah.
Generally speaking, uh, for those who want jobs or want a job and they're willing to be somewhat portable, you can get a job. Um, you know, a year ago, not only can you get a job, there are recruiters calling you twice a day to switch jobs and to make more money.
Hmm.
So the change has been that's not happening, but there's still a bunch of help wanted ads. You're seeing pockets of layoffs here and there, but those pockets of layoffs are coming from companies and industries that overhired.
Hmm.
They were hiring people in 21 and 22 coming out of the pandemic, thinking if I don't hire them now, I'll never be able to find them in the future. So you had a lot of overhiring. Amazon was one of the companies that did it. Facebook was another company. a lot of the biotech companies as well. You've seen layoffs here and there, but we still have a national unemployment rate that is under 4%. What's it going to take in the new economy and the new era here to get a recession? Probably a 4.5% unemployment rate.
Hmm.
Mm,
Yeah.
and I just don't know that we're going to get there.
Yeah, I mean, historically, anything below 4% has been considered full employment because you
Full
always have
employment.
a handful of people that don't want to work, not that they have
Right.
to,
That's right.
right? So I think we're really in a good position, and it's also nice to see that we're making money,
Yeah.
just
So what do
like
we
all of
say?
us.
So the consumer is still spending, and we just articulated why, because they have a job. And now we're looking at wages. Well, they have a job and they're making more money. So we just tied all three of these together. So here is your increase in wages that you've seen. This chart is deceiving because it pulls the pandemic in. So you can see that big fall off cliff,
Right.
and then you see a big spike higher. But you do have consumers continuing to get raises and make money, so on and so forth. A lot of this has to do with cost of living increases. Well, cost of living increases are tied to inflation because inflation was hot. The cost of living increases were hot.
Mhm.
So I think this will normalize a little bit and flatten out going forward, seeing that it is tied to the inflation rate. But you have full employment, you have consumption, and you have income rising.
It's a great setup, and I think the consumer overall looks really good. If there's one area maybe of weakness, it's more the sentiment of the consumer. And I really love this slide because it's so interesting to me that consumer sentiment back in 2022 on the far right, that blue dot, fell below the financial crisis of 2008. That
Mhm.
is how terrible we felt, right, as we started raising interest rates in this recent environment. We have come up from there, but we are still well below the average. And I think where there's room for opportunity on what we're looking at is that consumers historically, when we feel terrible, we tend to see the stock market return moving forward 1 year at its highest, versus when we feel the best 1 year later, the S&P historically is a little bit more lackluster. And just to prove that point, in the box on the upper left, it actually highlights those peak moments that we have felt the best going back to the 70s. The S&P return 1 year following averaged 3.5%, versus when we felt the worst at the bottom and 1 year following, the average return of the stock market was 24%. That's a massive difference.
Absolutely. We highlighted this over the past couple of years. The June 2022 bottom there, and then again it happened. It kind of stuck around that number until September, October of 2022. Those were very large investment entry points for us, and I think all the clients listening probably saw the transactions in their accounts. We've talked about this many times. You want to invest heavily when you feel like you should do the opposite, when you feel like we're going to be in a recession, when the noise on TV is all negative when it comes to the economy and the stock market, when the direction of the market is moving down, that is when you want to invest heavily. And I know it's the feeling that you have during those moments is to take all your money out and just say, well, I made money over the years. I can rationalize where I'm going to sell at the bottom. I just can't take it anymore.
Mhm.
You always have to do the opposite. You have to say, I know I feel terrible. I should invest more money, or I should reallocate some bonds, conservative stuff, into stocks. I know I should do the opposite of my emotions. And here's a perfect chart that shows it. When you feel terrible, it is the best time to invest money. That has always been the case and very likely will always be the case because we're humans and we're emotional. So
I was just going to say, I think that's why behavioral finance is so important,
it's
right?
so
Because you
important.
lose the
So
feeling.
important.
Yeah.
Yes. Yes.
And so let's talk a little bit, Bob, about some specific areas of the market this year that we think could be an opportunity.
Yeah, for the past 6 months, so starting in the summer of 23, we started putting some of these slides out here and talking about small companies versus large companies, and the fact that we think there's an enormous opportunity going forward. Um, we believe that small cap stocks, smaller companies, are going to outperform larger companies this year and potentially for a couple of years moving forward. We do think that large companies are going to do completely fine. They're going to do very well, But the opportunity, the discount that exists relative to large companies, when you look at small companies, is as wide as you can get. You have to go back to the tech bubble of 99, 2000, 2001 to find small companies this cheap. So what we started to do was this summer, we started to add some chips, in essence, into the small cap arena for our clients very slowly and subtly. Sometimes we did it through a mixed fund where you wouldn't even know it, but we're trying to build client allocations in small caps. And we still have those very wide valuation spreads where small is way cheaper than large cap. And we have consistently been rebalancing into and picking up small caps for our clients. And that's a theme that our clients might see us execute on probably throughout the year, potentially even into 2025. This one is we feel very strongly about. Now, I warn everybody, you're never going to be you're never going to have a portfolio that's more exposed to small companies versus large companies. Why? Small companies are more volatile. So small companies are like using hot sauce, right? You can't put lots of hot sauce on anything. Otherwise, you'll spoil the taste. And it just becomes too spicy. Same thing with small cap investing. When I say we're adding, yeah, we're adding small percentages. We're going to get to an overweight in our terms of small cap relative to where we've been in small cap. Sometime this year, we're going to stay there. But that doesn't mean it's going to overwhelm the portfolio. Remember, a lot of what we do is also risk management. So behind the scenes, and we don't talk about this enough, just because it's confusing and it's a lot of technical talk. We have risk controls on portfolios, and if we put too much hot sauce in the soup, it'll make it too spicy, and risk will get out of control. So that is not something we're looking to do. We're just looking to build up our exposure.
Exactly. I think that's a great point. It's never a decision of getting in or out. It's more dialing it up or down. And
Exactly.
I know that there's one more comment you wanted to make on small caps.
Yeah, part of the discount in small caps relative to large caps is small companies are more sensitive to the economy, and by virtue of that, they are much more sensitive to restrictive interest rates. So when rates are high, big companies, it really doesn't matter. They really don't care, and it makes almost no impact to gigantic companies. Small companies, it makes a big difference. And a lot of it has to do with how small cap financing is set up. Whereas Apple gets a call from the California state pension system, they want to buy Apple bonds. Apple will create a bond offering. They'll issue a bond for 20 years. They'll pay 3%, and it's fixed for 20 years. Small companies, they'll issue a bond, but the interest rate is floating. It adjusts every 90 days. So, in an environment where interest rates rise,
Right.
Apple still has a 3% bond that they're paying. A small company had a 3% bond that is now yielding 6%.
Yeah.
Now, as an investor, it seems okay because you're getting a higher yield. But as the payer of that interest, your interest expense for your business just doubled.
Hmm.
So, you might have to, when you look at your bills, say, you know what, I can't employ 10 employees because finance costs has gone up. So these smaller companies, because this is widely known, smaller companies were not being bought in the stock market as much as large companies because, hey, wait a second, finance costs, the pain of higher finance costs is immediately felt by small companies.
Right.
Now, what we're seeing and what we thought internally was this is being overestimated and it's overly cautious. Um, a small company today is a $9 billion company. That's enormous, right? So when you look at a lot of this historical data, it is pulling in old small caps when they were worth $500 million of market cap. Today's small caps are significantly larger. So a lot of the financing has been fixed. Some of it's floating, but you're about to have rates come down. So if rates going up was a negative, rates coming down is clearly going to be a positive for these companies. They're going to be much more profitable simply from the fact that rates are going to come down. If they do nothing else, they'll have higher earnings because less interest expense. So I don't want to get too optimistic here, but this one is one of our main high conviction points for 2024.
Mhm.
There is opportunity in small cap for many reasons. This is a big one.
It's a big one, and as you pointed out, they're very sensitive to interest rates. So,
That's right.
and one other theme for this year in equities, I'll kick this idea off by just sharing what happened last year because it was so unique. If you're looking at the slide on the left-hand side, as we mentioned at the kickoff of this webinar, the stock market was so strong in 2023. In fact, if you're looking at that gray line, the S&P was up 24%. However, we spent a lot of time last year talking about the Magnificent Seven and the concentration. And just to give you an idea, the top 10 stocks last year, if you look at that green line, were up 62%. If you take those 10 stocks out of the S&P and you've got the 490 that are left, they were up 8. It
That's
was
right.
one of the most concentrated returns we've ever seen. So the question we have to ask is that going to continue?
Yeah, it was a great year to be concentrated in not diversified last year. But if you look over 24 months, your return would have been zero in those same stocks.
Correct.
Because all the stocks that led the way down in 2022 are the top 10 stocks. So over 24 months, you didn't really make any money in those stocks. The bottom portion, or I should say the majority, the 490 of the S&P 500 companies, yeah, they had an average return, let's call it. There's lots of opportunity for them going forward. There's opportunity for the biggest companies, the top 10 going forward, but the other S&P 500, the 490, I think there's probably more opportunity for a bunch of them moving forward. Not to mention, they are cheaper. Their price to earnings ratio is quote unquote cheap. When you add the top 10 companies of the S&P to the other 490, you wrap it as the S&P 500, the PE ratio is, let's call it fair value. It's just under 20. When you pull out those top 10, the fair value drops. It's discounted by 10%. There's opportunity in the S&P 500 490 going forward. There's
Yeah.
room to run for sure. And look, at the end of the day, it's like any race. There always has to be someone who leads the way.
Mhm.
And it was very clear that it was the top 10 companies this past year that led the way. You already started to see a small rotation in the last 2 months of the year. All the other stuff, all those other good companies that really weren't collecting as much money as the top 10 from investors, they started to wake up quite a bit.
Yeah.
So, and we think that trend will continue throughout the next couple of years. There's always a lag with those, but that's good because it creates a longer positive path.
Yeah. And I think you're leading us into sort of that last idea in terms of stocks this year. And some of the ones that were so, that were more hurt last year were these dividend paying stocks. And
Yeah,
and I will say this, and I love this slide. Dividend paying stocks historically relative to the S&P trade at a discount. They trade historically at a 13% discount. That discount right now is double that. And at one point the discount went all the way back to what we saw in the tech bubble, which to me is just mind-boggling. So I think that's another reason to look at dividend paying stocks going forward. And I think one of the reasons they were so decimated more recently is, as we talked about before, there is competition in the market. And if you're getting 5% in money market, that's competition for these dividend paying companies, right?
yeah, yeah. To clarify, that's a great point, and I know you love this chart, and it's growing on me as you're talking to. Um, so I think a lot of our investors, our clients, are aware of the dividend paying stocks. They call them the bond proxies. They're not bonds, but they have a yield, so they kind of look like they're bonds. They do well over long periods of time. I'll be honest with you. They they are known for their dividend. The big dividend payers are known for their dividend. They're not known for their enormous earnings growth. They're not known to grow like Amazon or Apple, grow their earnings that quickly, but they reward you with a bond-like dividend, right? So in a normal interest rate environment where rates kind of hover between a very tight band, let's just call it normal, these bond proxy stocks, the dividend payers, the payers that are also growers, they do incredibly well. They also give you market return or very close to market return with less risk measured by the beta of the stock price relative to the market. However, there are there are two periods where they either do much better than the market or much, much, much worse than the market. And this is really not even a reflection of the company. It's a reflection of the environment relative to what the company's offering. Okay. So they do very well when bond yields are very low.
Mhm.
The bond proxy stocks, I'll use a utility company, right? A highly regulated business in this country. Earnings growth is actually capped, right? If you earn too much, you got to give refunds back to your customers. But they pay, 3 to 6% dividend yields, depending on the company. When do you think they look good? They look good when you go out in the bond market and all you can get is 2.5%. They're paying you 3.5%. So let's buy the bond proxy stocks, the utility companies, because the yield is great and they have this pretty consistent earnings growth, right? We need electricity, don't we?
Yes.
So they look good in a low rate environment. They tend to actually outperform the market. In a normal rate environment, you get slightly below average return, high dividend yield or high dividend growth, but you also get less price volatility,
Mhm.
right? So it's a much more conservative stock, generally speaking. They look bad when bond rates are high and the stock market is volatile. Why? Well, because when bond rates are high, just buy bonds to get the bond proxy yield. And in
Exactly.
some cases, when bonds are very high, you'll get more yield with less risk, or in some cases, no risk by buying bonds versus buying a stock with a high dividend. In fact, so what happens? Well, money in motion, you sell the big dividend payers, or in this case, over the past couple of years, there's just no buying of the dividend theme. And there is buying. When you stop buying, where does the money go? The money went into the bond market.
Right.
So it's not that a lot of money came out of these dividend paying stocks. It just wasn't going in. That money was rerouted to buy bonds, to buy, treasury bonds, corporate bonds at, 5 and 6% yields. This is what we did as well. Now, if you're a client of ours, you've got your fair share of dividend growth stocks and dividend payers. They're great. They're also on sale. And
Mhm.
keep in mind, I just said in a high rate environment, price wise, they're not treated well, at least relative to the other parts of the market. But in a declining rate environment, those bond proxy stocks, those dividend paying stocks that look like they have a bond component to them, they don't. It's just a high dividend yield. They start to look more and more and more attractive. And we think this is another underrated, under-discussed theme. A lot of the dividend payers and the dividend growers are also very cheap. Keep in mind, most of these companies wouldn't be paying a dividend if they couldn't afford it, and they're not growing earnings. Most of them are. They look very attractive here. So our clients already have a fair allocation to them. Just a reminder that this theme will start to play out quite well, probably over the next few years. And I say few years because that is the what the Fed is saying is going to be their path or
Their
their
path. Yeah.
to cut rates.
Yeah.
So
So, and I think hopefully what the listeners are gaining from this is there's a few areas of the equity market that we see opportunity going into this year that's unique from last year.
yeah,
And one last point on the stock market, because I think this question has come up. A lot of clients and investors were surprised to see the year-end rally with the market going higher than 10% over November and December. We did go back and take a look. That has happened 6 previous times. And the question that arises is, well, is it over? Right? Are we done? We just saw this rally, and the answer would be no. When you look at those 6 previous periods where the market rallied 10% in those last 2 months, the following quarter averaged 6.6%, and then the following year averaged 19 and a half. So there's momentum here that we think can continue.
yeah. If we just use history and look back, this is a very good setup. You don't have double digit returns in the last 2 months of the year that often. You have good returns, but double-digit returns, it's happened now, what, 1, 2, 3, 4, 5, 6, 7 times. It's not luck and
Mhm.
it's not a mistake. It's because there's value in the market. And it's value in the market in our case now. It's also because we have monetary policy that is set to become less restrictive, which is a significant positive
Mhm.
for the capital markets. So there are even more reasons to be bullish this year. And this is, again, we're trying to articulate to you why we feel the way we feel and what we're seeing and why. This is just another thing to look at for you.
Yeah, absolutely. And I think one last area of opportunity for this year, we've talked about it before, but bonds are back.
Bonds are back. Yeah, our theme again coming out of 2022 into 2023 was, we're gonna enter a bull market for stocks and bonds, and we're right. And I think we're going to continue to be correct here. Keeping in mind, bull markets last on average 7 or 8 years. A bear market lasts 7 or 8 months. So it's 10 times as long. I know it doesn't feel that way, but that is the case. It's just the way it works. We can back it up and show you anything you want. The impact of a change in rates of 1%. So in Fed talk, that would be 4 cuts. So if there are 4 cuts, this is just math. This is an opinion. This is just math. And we think it's wise to educate our clients as to how bond math works. If there's a 1% change in rates, 1% rise or fall, the rise is on the left-hand side, the fall is on the right-hand side. Generally speaking, the fall in rates creates positive price momentum for bonds, but it's more positive than you think.
Yes.
So, you look at 10-year treasuries, if there's a 1% cut in rates, you have a yield of right now of about 4%. About 6 days ago, it was 5%. But you have the duration of the bond. Let's just softly call it the average maturity of those bonds in the portfolio, multiplied times the change in rate gives you the upside price return. Then you add the yield to it. Wow. It's twice as good. Yes. A declining rate environment does wonders for the price of bonds. Why? Because if you buy a 6% bond today and tomorrow the new yield is 4, your 6% bond looks so attractive in a 4% bond environment. I'm going to leave it at that. That is
Yeah.
just the simple way to view it.
Yes.
We have highlighted some areas we shaded them on the left in let's call it a gray rectangle. 10-year treasuries, investment grade corporate bonds, convertible bonds, US high yield bonds, and municipals. If we have this decline in rates, those bonds historically have provided double-digit positive returns in a declining rate environment. And again, this is assuming a full 1 point change or 4 cuts. If there's more, price return will be more. If there's less, price return will be a little bit less, but not negative.
Yeah.
How
It
about that?
is equity-like return with less risk than owning stocks.
Yes. And it's early on that you get these better than expected returns in the cutting cycle.
Mhm.
And it's usually the first and second year that you see the full impact price wise in a declining rate environment.
Yeah. It's a great opportunity. If there's ever time to own bonds, it's when rates are high and they're cutting, and we think they're there. So thank you for that.
Yes.
One last point in this webinar. We are in an election year.
We have to
So
talk about it.
darn it.
Because we're probably asked about this the most. What happens if this person wins the election, or this party wins the election, or that party wins the election, or so on and so forth? And what do we think? Um, we think, because we can show you, the party really doesn't matter. When you look at pre-election year or election year, the party really doesn't matter. Whether it's blue or red, companies figure it out, investors figure it out. So it doesn't historically really favor one versus the other.
Yeah.
And I hate these political charts because what the current administration is doing isn't really seen until the next administration comes in, right? That's just the way it always is.
Mhm.
There's a lot of policy change. There's a lot of change that could happen if there's an administration that deploys a lot of change and executes on that stuff. And the benefits of that stuff, or the negatives of all those changes, aren't really seen until the next administration comes in,
Yeah.
generally speaking, because it takes time to watch those changes happen in the economy and the system,
And implement.
regulatory wise, mergers and acquisitions, everything. It takes a very long time to properly measure it. So what ends up happening is a new president gets in and they benefit from what the prior president has done, even though they talk nothing but bad about them, and nobody gives anybody credit in politics. So I would say whatever Biden has done, good or bad or anything in between, the actual impact of that will be seen in the future. It is really, truly not seen now. The full measurable impact, at least economically and financially,
Right.
and for small businesses and big businesses, it won't be seen for years. So what we're seeing right now, and I know I'm going to have tomatoes thrown at me for this for saying this, but it's very likely that the prior administration and those policies created whatever we're looking at here, any strength, so on and so forth. And whatever we're seeing right now in politics will be seen in the future.
Well, I think it's a very fair point because we talk all the time about the fact that economic cycles are much longer. And
Yeah,
so 4 years is very short within these economic cycles, and that's what
exactly.
happens. Yeah.
Exactly. And regardless of who the current president is, the prior president or the next president, they come in saying they're going to do all sorts of things. And you all know that, you know, 10% of what they said they were going to do actually gets executed and done. So I can water it down even more. And I can say, well, we might be still thriving off of the policies of the 90s plus a little bit from the three prior presidents, and you just keep layering it on. Does that make sense?
It
Yeah.
does.
So in today's day and age, everyone wants to get super political and point fingers and blame everybody else. At the end of the day, it probably has a lot less to do with the actual person in their administration,
Mhm.
um, unless there's an extreme positive policy change or a very, very negative policy change. Don't get me wrong. If taxes go up to 70%, that's horrible. That's clearly horrible.
Right.
It's horrible for you, the taxpayer, the economy. It's horrible for corporations. Many companies will go out of business. There are just too many companies trying to sell, poke tuna in Westport. If taxes go up by 70%, I think all consumers are going to narrow the scope of their consumption.
Mhm.
It's bad for business, but you understand what I'm saying.
Yeah, no, absolutely. And I think one last study that was interesting is about approval ratings. If you wanna bring this all home.
Yeah, so we get this a lot. What do you think is going to happen with the election? And I get it. This year, this setup here is unusual, right? We have a current president that is up there in age. We have the leading contender on the Republican side who is up there in age. Um, we have a lot of distaste for the current president. We have a lot of distaste for the leading candidate in the Republican Party, the prior president. Um, you just think if everybody hates everybody, how do these people get elected? But
Right.
it is what it is. What we're showing you here is it's very likely we're going to have some change this year. Now, we don't know if nobody knows if it's going to be Democrat versus Republican, but what we're seeing is there might be a different candidate on the Democratic side. I would say, when you look at these approval ratings, what we're showing you here is a chart. We have this going back to all presidents, but this is just the last six presidents. What we did is measured the current president's presidency, however many days into his presidency he is, relative to the past six presidents. And we're illustrating the net approval rating. The net is you take the um, positive approval
Mhm.
minus the disapproval, right? So the middle is kept out of this. So you take approval minus disapproval, and what you have is Biden having the worst net approval rating in history, and then we compared it to at this point all the other presidents. We're showing you the last six because that's really probably what matters most. We go back to Reagan, and uh, Biden's approval rating overlaid versus Trump's approval rating through this point in his presidency is worse than Trump's and by a pretty significant margin, which is why on TV you're probably hearing things like, hey, we're not sure Biden's going to be the candidate, which is why you're hearing a lot of Democrats talking about replacement candidates, which is why you're probably hearing a lot about Gavin Newsom, so on and so forth. And there's many reasons, right? You're hearing people talk about his age. You're listening to the way he speaks, and I think a lot of people are picking up on some what is perceived to be maybe some cognitive decline. So I'm just shocked that it's worse than Trump's, right? It just kind of sticks out to me we didn't know the numbers until we started running this, and then we had it illustrated, and here it
Right.
is. So what does that mean to me? That means that there's going to be political change, in my opinion, right? Um, so what does that mean? Not sure yet, right? Because uh, they don't know who they are yet, if there's a change. And there doesn't seem to be any strategy or plan. Usually there isn't until you either win or lose, right?
Mm-hmm.
They are just campaign talking points. And then when there is a plan, how much of that gets executed? So who knows? Very likely going to be some change politically. One thing I should also point out, very important, half of the population in the world is going to the polls this year. There are major elections this year in most of the world, and it usually doesn't happen that way. Remember, outside of the United States, they have different cycles, right? They have different election periods, different administration terms, so on and so forth. If you're in Russia, you say you have an election, you really don't. You know what I'm saying? So, however, this year, half of the globe, half of the people on the planet are voting in some election. Get ready for lots of political change this year. Lots of political change this year. It's not just the US. It's going to feel like, and it's going to sound like there's change happening everywhere.
Yeah.
Yeah, I say that because there are many other leaders in other countries who have met their term limits, right? Depending on the country's rules, they're set to exit anyways. So even if the same party wins, it's going to be a different person with different policies, a different viewpoint. It's going to be a lot of change this year.
There is going to be a lot to talk about.
Lots to talk about for the entire year. We're
Yeah.
very excited.
Yeah.
A few things. The market is going to be volatile the way it always is. It's volatile for a reason. That's if you can ride the volatility, that's where you get the return. If you can't ride the volatility, you'll get no return. That's just the way it is. So we look forward to that volatility. We look forward to explaining what it is, why it's happening, and how we're taking advantage of it. But it should be a very good year. Um, don't be impatient. If January is a down year, so what?
Mhm.
If February is a down year, so what? We illustrated to you earlier that returns come in bunches. It never just comes slowly and consistently. That's a dream. We are realistic. We are real. Returns come in bunches, just like losses come in bunches. But don't worry, over time, there are more gains than losses over time. It again should be a good year where we think in the second inning of a bull market that has years to go. And you should feel good about that if you're listening to this video. And if you're not, shame on you. You should be listening to the video. So
Well, I hope the listeners can sense it. I think that's a great summary. And as always, Bob, we appreciate the insight, and I'm looking forward to continuing these this year. So thank you.
very excited. And thank you,
And,
everybody.
and thanks everyone for listening. And as always, please reach out if you have any questions to any of us here at Principal Wealth Partners.
Great. Thank you.